Choosing between term life insurance and whole life insurance is one of the most misunderstood decisions in personal finance. At first glance, the difference seems simple. One is cheaper and temporary, the other is expensive and permanent. But beneath the surface lies a complex web of costs, benefits, trade-offs, and long-term implications that most people are never fully told. Insurance agents, financial advisors, and online influencers often present biased views depending on what they sell or personally believe in. Some push term insurance as the only logical choice, while others promote whole life as a powerful wealth-building tool. The truth is not black and white. It sits somewhere in the middle. To truly understand which option is better, you need to go deeper into how each works, what they're designed for, and what they don't openly advertise. Today, we're diving into term versus whole life insurance, the truth they don't tell you. So, before we start, make sure to hit the like button and subscribe to the channel. Let's begin with term life insurance, the simplest and most affordable option. Term insurance provides coverage for a specific period, usually 10, 20, or 30 years. If you pass away during that term, your beneficiaries receive a death benefit. If you outlive the policy, it expires with no payout. This is the first truth many people overlook. Term insurance is designed purely for protection, not wealth building. It's like renting coverage. You're paying for peace of mind during a specific phase of life. The biggest advantage of term life insurance is its affordability. For a relatively small monthly premium, you can secure a large amount of coverage. This makes it ideal for young families, individuals with mortgages, or anyone with financial dependents who rely on their income. It allows you to cover major responsibilities, like education costs, daily living expenses, and outstanding debts, without putting pressure on your current budget. Because the cost is low, many financial experts recommend a strategy known as buy term and invest the difference. The idea is simple. Instead of paying high premiums for whole life insurance, you invest the savings into higher return assets like stocks, index funds, or mutual funds. Over time, this approach can potentially build significant wealth while still providing essential protection. However, here's the part they don't always emphasize. This strategy only works if you are disciplined. It requires consistency, patience, and a long-term mindset. In reality, many people don't invest the difference, they spend it. And that creates a hidden risk. You may end up with neither strong investments nor permanent coverage. Another important consideration is what happens when the term ends. As you get older, premiums increase significantly and your health may decline. This means renewing or buying a new policy later in life can be extremely expensive, or even impossible if you develop certain medical conditions. This creates a potential gap in protection right when you might still need it. Now let's turn to whole life insurance, often marketed as a lifetime solution. Whole life insurance provides coverage for your entire life, as long as premiums are paid. Unlike term insurance, it includes a cash value component that grows over time. A portion of your premium goes toward the cost of insurance, while the rest builds a savings-like account that accumulates value on a tax-deferred basis. One of the biggest selling points of whole life insurance is its guarantees. Your premiums are fixed. Your death benefit is guaranteed, and your cash value grows at a predictable rate. Some policies also pay dividends, which can either be reinvested to grow your policy or used to offset premiums. This level of certainty can be very appealing, especially for individuals who prefer stability over market fluctuations. But here's the truth they don't always highlight. Whole life insurance is significantly more expensive than term insurance. A policy that might cost $50 per month with term insurance could easily cost $300 to $500 per month or more with whole life insurance for the same coverage amount. In the early years of a whole life policy, a large portion of your premium goes toward fees, administrative costs, and commissions. This means your cash value builds slowly at first. Many people are surprised to learn that if they cancel their policy within the first few years, they may receive far less than they paid in. Another misunderstood aspect is the return on investment. While agents may highlight dividend rates or projected growth, the actual internal rate of return is often modest, typically around 3% to 5% over the long term. While this is lower than historical stock market returns, it comes with significantly less volatility and risk. In that sense, Whole life insurance behaves more like a conservative asset, similar to bonds or fixed income investments. One unique feature of whole life insurance is the ability to borrow against your cash value. This is often marketed as a powerful financial tool, and it can be, but it's important to understand how it works. Policy loans are not free money. They accrue interest, and if not managed properly, they can reduce your death benefit or even cause the policy to lapse. However, when used strategically, they can provide liquidity without triggering taxes or requiring credit checks. A key difference between term and whole life insurance lies in their purpose. Term insurance is designed for temporary needs, income replacement, debt protection, and safeguarding your family during your working years. Whole life insurance is more about long-term financial planning, estate preservation, and creating a guaranteed legacy. Another truth that often goes unspoken is that the best choice depends entirely on your personal financial situation. For most people, especially those early in their careers, term insurance offers the best value. It provides maximum protection at minimal cost, allowing you to focus on building wealth through other investments. Whole life insurance, on the other hand, may make more sense for high-income individuals who have already maxed out retirement accounts, built substantial investments, and are looking for additional tax-advantage strategies or estate planning tools. Taxes also play a role in this decision. Term insurance offers a tax-free death benefit but no additional tax advantages. Whole life insurance provides tax-deferred growth, and policy loans can often be accessed without triggering taxable events. For individuals in higher tax brackets, this can be a meaningful benefit. Liquidity is another important factor. Investments like stocks and mutual funds are generally more accessible, though subject to market risk and taxes. Whole life insurance builds liquidity more slowly, and accessing cash value in the early years can be costly due to surrender charges. Risk tolerance matters as well. If you're comfortable with market volatility and focused on maximizing returns, combining term insurance with investments may be the better route. If you value predictability, guarantees, and long-term stability, whole life insurance may align better with your mindset. Perhaps the most important truth is this: the decision is not strictly one or the other. Many well-designed financial plans use a combination of both. You might rely on term insurance for high coverage during your peak responsibility years, while also maintaining a smaller whole life policy for long-term stability and legacy planning. This balanced approach can offer flexibility, protection, and peace of mind. The real key is clarity. Understand your goals, your financial habits, your risk tolerance, and your long-term vision. Only then can you choose the strategy that truly works for you, not just what someone else is trying to sell. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.